Well, good morning, everyone, and welcome to the very first Pork Academy session of World Pork Expo 2024. This morning, we're going to be taking a look at the economic outlook for the pork industry. To start out, my name is Ever.Ag Jenkins, and I am a second-year PhD student in the Applied Swine Nutrition Group at Kansas State University, and I am a 2023 Real Pork Scholar. And so through this Real Pork Scholars program, not only does my research in sow productivity and nutrition get funded, but it's also a chance for me to network with individuals at universities across the country, as well as be mentored by a leader in our industry. And lastly, I get to go through a plethora of communications training where I learn how to communicate the research and the really great things that we're doing in the pork industry with our consumers and the general public. So before we begin, I would like to encourage everyone to scan this QR code here on the screen. That will allow you to receive weekly updates from the National Pork Board, and it's just a really good way for the National Pork Board and Pork Checkoff to keep in contact with everyone. It is my pleasure to introduce our session moderator, Dr. Brett Kaysen. Dr. Brett Kaysen serves as the Senior Vice President and Producer and State Engagement Lead at the National Pork Board. And so he is in charge of leading the organization-wide grassroots effort in order to support pork producers in their priorities and also build trust and add that value to the U.S. pork. And so if you'll all please help me in welcoming Dr. Brett Kaysen.
Well, good morning. That's a hard act to follow, isn't it? Didn't she do great? Give her a big round of applause. That's the future leaders here. Well, let's get started. And first and foremost, I would say, what an opportunity that we have this morning to hear from what I would call two legends in our industry, or titans in our industry, as I like to call them. And also thanks to the National Pork Board for allowing this session to be moved upstairs. This is always one of the most widely attended sessions for a multitude of reasons, and so you've got more room than you've ever had, and so thank you for the Pork Board, Cheyenne, and crew for all the planning. First and foremost, if we'll move a slide, I think we have the antitrust statement here, Cheyenne, and so take a few moments, look at this on the screen and review. I'm not going to read through it with you, but it's important that you understand the antitrust statement and what we're gathered here to do today and what we're gathered to not do. Also, please note, and I've been reminded of this several times, and again this morning a couple times, is there's a quick turn in this room. And so at the conclusion of this particular program, we're going to ask that you do your best to move on to the rest of the fairgrounds and network. And Cheyenne, I'm going to make her jump a little. We've got till noon, right? No, I did that on purpose. What time would you like us to be done, Cheyenne? 10:45. Yeah, 10:45. I'm telling her that so I can make sure that she's paying attention. But we're going to try to conclude for our 10:45 because they're going to do a quick turn and set this room up. So just keep that in mind. This morning we will cover what demand looks like for pork, both internationally and domestically here in the U.S., talk about prices relative to corn and soybeans, pork markets, pork consumption, and much more. And I have the pleasure of introducing our speakers for this morning's session. And they will come in an order in which I introduce them, but I'll introduce both of them to get started. First that will be speaking with you is Mr. Joe Kerns. He serves as the president of the Livestock Division of Ever.Ag. He's representing over 30 years, pretty good for a guy that's only 21, 30 years of experience working with producers, suppliers, mills to support agricultural operations, and Joe assists clients with procurement and risk management activities related to hedging, ingredient purchasing, feed quality control, diet formulation, operational benchmarking, livestock marketing, generational transitioning, and business development, and all duties as assigned, Joe. So we're glad to have you. And Dr. Steve Meyer, who wore his favorite colors for you today, serves as the lead economist for Ever.Ag with significant experience in the hog industry. Steve joined the company in 2018, and in his role, he speaks at various industry topics, industry topics, develops and delivers economic data and analysis, and works with clients to provide critical perspectives. And one thing we know with Dr. Meyer today is he's going to teach me, the animal scientist, what the true definition of demand is. He's been working on me for a long time, and I think I'm going to get it. We're going to have both of them present, and then we'll leave time and the opportunity, Joe and Steve, I hope, for some dialogue and a Q&A session. So, with that being said, please welcome Joe Kerns. Thank you.
Thank you, Dr. Kaysen. That picture that was up there, that was actually taken as a joke. We had a gentleman in one of our divisions that wore a blue blazer and a white shirt, and so all of us emulated his exact same pose and sent this out without saying anything, and somehow it got picked up as my picture. So that's, we got new ones coming, by the way. Be there. I love what we get to talk about here today is kind of the lead off. And we had a breakfast meeting this morning, and it came up in dialogue about what's the most important thing in pork production. Is it productivity? Is it feed efficiency? Is it the cost of the commodities? And it's like, no, it's none of the above. It's none of the above. It's the revenue side, right? And so I get to play Ed McMahon to Johnny Carson over there wearing orange. Because truly the revenue piece is where it's at, but we can't ignore what is going on with the price cycle of our inputs, of our grain side of it, and we're going to see some changes that are going to be coming here. And all right, the good things come to those who wait, which, by the way, when they said we were in the upper room, I was waiting for like the disciples to show up too and make that all kind of occur. But good things come to those who wait if you can hang on long enough. And I know that sounds terrible. On the back of 2023, which was just an absolutely pathetic year for pork producers, coming into 24, we were either side of break even, depending upon how you've done your hedges. But if we can just hang on a little bit longer, I think we've got some really, really good things coming at us, and we'll tease those out as we go here. 2 years ago, it's almost 2 years ago to the time frame, we were acquired by Ever.Ag. We're a small component within the financial services division. We got the president of Ever.Ag is here with us today, but it's really investing in this pork sector, kind of this end-to-end solution. The most recent acquisition was the Prairie Systems folk, but you guys kind of sit there to the left-hand side there, but it's either side of what you're doing, the input stream coming into your farm or starting to track where things exit the farm and trying to put together this end-to-end solution for production agriculture. This is just our side, the financial services, and kind of where we interface, and I'm really excited about what the future looks like and where we're going with all of that. So agenda. A few things have me worked up, and if you've seen me speak before, I can't sit still most of the time, and this is a really good time. But we're going to talk about the crop that we've got going in the ground, what the acres look like, what the production prospects look like, but most importantly, in my opinion, is where the demand sits and what that kind of looks like. And there's some moving parts, guys. There's some really moving parts inside the demand piece that we're going to kind of tease out. In the interim, this is all about money flow. And if you can follow the money, and I'll show you what that's going to look like, you're probably pretty good at predicting where price is going here. And for corn, and by the way, I'm not Dutch. I was going to make a joke, but I decided not to right there. Does anybody know what a Dutch auction is? Everybody's been to an auction where you raise your hand until the last guy's here. Does anybody know what a Dutch auction is? We start high and bring it down. The first guy that raises their hand is the owner. And I think that's what we're going to have to do with corn. The price of corn is coming down, but I believe it's going to hit a threshold where you're not going to have the confidence of, by golly, it's bounced off the bottom and then I'm going to buy it. I don't think that's going to work, and I'll show you why here in just a little bit there. This government policies, as it impacts agriculture, in my opinion, is probably the biggest component that's going to impact us as we roll forward here. And specifically, when we become very insular. Do we want to trade with anybody? And we had breakfast with some of our colleagues from China this morning. It's a wonderful discussion. And you talk about just the variances, that we have a community goal of what we're going to do to help out our individual causes, but we've got to be realistic about some of these policies that are drawing us back in, right? We've got a renewable diesel rollout here, and we the U.S. taxpayer are subsidizing cooking oil from China that is flowing into renewable diesel. Does that make any sense for those of you writing the check? No, but it's real. This is just real. We've got the exact same thing going on with Brazilian ethanol. Our ethanol does not qualify under the current rules in order to make sustainable aviation fuel. Does that make any sense for your taxpayer dollars? No. Not whatsoever. But here we are, and I do think that those things will change and be addressed. And world balance tables in corn are absolutely boring, and that's why I think this money flow thing is moving there. I'll go through the U.S. balance sheet. The soy complex is probably the easiest one to handicap, is we are awash in soy across the world. The import demand coming from China, basically, that 70% of world export trade of soybeans is reasonably weak, and we find ourselves awash in soybeans, and we'll talk about that. And I think that if you had a take home at this point in time, if you are a producer and you've got beans growing in the field, and we broke $12 here earlier this week, that's probably a good $1.50 higher than where I think they're going to be once we get to harvest. And we're going to contextualize what we're doing for a governmental policy and where we're going, because it is real, against this backdrop, right? Is the world is adding more coal capacity than we can decrease. A lot of that decrease on the right-hand side over there, United States decreased about 10 gigatons of capacity there. It doesn't matter. It doesn't matter. The world is moving. And so if the United States is roughly 15% of carbon output, but we're trying to finance it all on our back, does that make sense? It doesn't. And it's also real. So you don't have to like it, but I think we have to accept the reality of where we go. Here's where we sit on the crop progress report. We are slightly ahead of normal as far as the crop going into the ground, the emergence, the good to excellent ratings also just came out. We are, let's call this normal, right? We're not going to argue about 1 or 2 points, one side or the other. Take a look at your favorite state there. By the way, there is something on here I've never seen before, and that is right there. I have never seen a good to excellent rating at 100%. And that's what Pennsylvania is showing right now. And look where they were last year. They were at 30% last year. That's a confused state right now, right? You got everybody, and maybe it's all in comparison. It was so bad last year that, look, Martha, it's pretty good this year. And we're going to call it good to excellent. I've never seen a 100% rating. I thought that was interesting. That is our first observation. So notice we always start this horse race at about the same level, and then varying degrees of anomalies with the weather. But we're starting off in a really, really good shape on corn. Similar situation to what we've got going on beans. We are plus or minus either side of normal of getting this crop into the ground, probably just a little bit better than what we are average there. And here's, we don't have a good to excellent rating. We haven't got enough beans out of the ground yet. But just take a look and find your favorite state. And then take a look at this weather forecast that we've got. And I'll go through that. But the weather that we're experiencing now is going to become the predominant component as we roll forward. High pressure system sits over top of us, some winds coming out of the northwest, so it's reasonably dry and reasonably cool. Are we going to get the rest of the crop in the ground? Yes, we are, right? That is not going to be what moves this market. There we go. There's your temperature outlook next 6 to 10 days. Notice and let's just kind of pick on Iowa a little bit. We were kind of the laggard a little bit, but below average moisture coming in on the 6 to 10 day forecast, something similar on the extended forecast to take us through the middle of the month here. Reasonable temperatures, 70s and 80s, nothing real hot, and really not quite as much moisture, right? So we've got enough moisture in order to germinate the crop, to get it to go, and now we've got a good condition in order to get the rest of the crop planted. Do you see any threats on what I've presented you so far? Is there any great big threat in this market? Nah, it's pretty benign. It does not look too bad. And if we take a further look, and you can read that fine print over there on the left, this is the longer term weather outlook there. Is it predicted that we're going to have a wet spring, which we have had? Is slowing the process here, the planting progress. But our summer weather shows the potential for a mild and wet season. Uh-oh. Does anybody mow a lawn? And what happens if it's cool and wet? What happens? How often do you run your lawn boy? Like every 4 days, right? What is corn? It's a grass. It loves that weather, right? This could be the year that we finally see what the magicians at Monsanto or Pioneer have actually put in the bag, and we start to get some favorable weather, because we have not had favorable weather for the last 5 years in a row. We don't know what normal is. Blame it on whatever you want. Global warming, it doesn't matter. Let's just talk about what is, not the why behind it. But we could finally start to see that genetic expression start to come out. I would tell you that the follow the money crowd, I picked this out. This is soybean meal, large commitment of traders, open interest, and we're going to kind of walk through this. But notice what happened here is we were kind of whoops, hang on. There we go. We're kind of rocking along here, and in about mid-November or so, the funds started to sell, and they sold kind of into the 1st of March or so, and then they started to buy and came up into this record level kind of the first part of May, all right? Remember those dates. We're going to go Nov to Feb to May. Here we go. Here's the price. There's November, there's March, and here's May. Do you think there's a correlation between the price movement that you see on the Chicago Mercantile Exchange, and some of us try to explain why did the market go up or down? Oh, gosh, I really don't know, because that is the honest answer. But if I gave you that chart, does it make more sense? Follow the money, right? And right now, the money wants to go away from our markets. This is a world corn production side of it. There's all the particular numbers here, but notice that the world is off about 8 million tons. Of that, the United States is off 12, and so everybody else kind of moderates us just a little bit. But we're going to kind of, I'll show you here the balance sheet, and when we drop down, 313 million metric tons was our carryout last year. It's going to be 312. We can't measure that close, right? That's the exact same number, guys, right? It is so boring what we've got going on right now on a corn balance sheet that the part that it does for you living in the United States is if I would ask you, where is Minas Gerais? Where is Rosario on a map? Could you pick them out? Probably not, right? What if I told you pick out where Minnesota is? What do you think? You can do it? Dang right you can. We are going to not have to guess what's going on because the United States is going to control the world corn balance sheet as we go forward here. This is what our balance sheet looks like right now. We've lost some acres. We work with a group, by the way, that thinks that 90 million acres is actually closer to 93. They're agronomic suppliers. Their fertilizer sales, their seed sales, they'd say, we're off a little bit, but not near as much. It's in the middle of Iowa, too, where some of these swing acres are coming from. We'll see what that looks like. But let's just take this one at face value. What we've got going on right now, 90 million acres at 181 bushels to the acre. Is that record yield? Yes or no? What do you think? Yes, by far. Matter of fact, last year, 177.3 was an all-time record, right? So, but just that adding of a couple of bushels to the acre every single year is starting to make itself shown. We end up with about 500 million bushels less, but look at our bottom line carryout actually goes up. Now, I've got, when I say we've got to pay attention to the demand side of it, we're going to kind of tease this out just a little bit. We've got this ethanol side of it, or total domestic use, going up 50 million tons. You've got the feed side of it going up, not tons, bushels. Feed side going up 50 million bushels. Exports going up here just a little bit. There's only one. Does anybody remember the Curly and what was that? The City Slickers. You got to remember one thing, right? Right. And when it comes to the balance sheet, there is just one thing. And I'm not trying to steal any thunder from Dr. Meyer here by kind of diving in to the feed side of it. But take a look. This is off that same report there. And this is production. This is in pounds. And notice that we go from 107.4 to 107.15. Do you see an increase in feed demand just based on that data? No, but the USDA sounds like, what in the world is going on? How do you do that? As a matter of fact, of these species, which one is the least efficient converter of a pound of feed into a pound of protein? The beef side of it. And take a look, the beef side of it's got the biggest decrease. You would expect, if anything, that we should be backing off feed demand, right? And yet the USDA's got it coming up a little bit higher. That doesn't make any sense to me. Our friends in the ethanol industry have demonstrated some profits. You've seen that in what you have to pay for corn coming on a basis side of it. But notice what happens here, guys. We have our foot to the floor. We've never been here before. And even if you give me this great profitability in the ethanol industry, they can pay up more for the corn, but they can't run any more through the plants. And we don't have any new plants coming online, right? It is as static as could possibly be here. Plus or minus 25, maybe 50 million bushels at the swing. ethanol has absolutely no place to go. So we take out feed, we take out ethanol, and what we're, by the way, there's your production side of it. It is bouncing back here, and that's why they've got profits, they can see this one go, but there's no way they're going to do anything else. And as a sidebar, the value of DDGs, notice where we sit in relationship to the demand curves. But look what happens once we start to get into this. What's that mean to you guys? That if I said, if we just took these observations over here on the right side of the graph, and I just said, what is my linear representation? What's it look like there? If you're to draw a line that's a least sum of squares regression, what do you get? Nothing. Absolutely nothing. And what that tells you is that once ethanol is so profitable and the DDGs are so surplus, if I'm the ethanol plant, I just got to sell the suckers at whatever price I have to in order to get them out the door so I don't clog up the plant so I can make more ethanol. That's all that's saying, right? So we've got this opportunity to really lose relationship in where the price of DDGs goes. I think the price of DDGs is just going to absolutely plummet coming into this summer here, right? Export inspections is about as tight. We're going to call that an orange line. I'm going to call that one yellow, that one orange. But notice where we sit. USDA has us higher in exports this year, and are we kind of trending right along that line? Yeah, we're almost dead on to it as we sit right now. And as I talk to you today, we are the market. The United States is the market across the world for July corn. We're not used to that. Normally we hand off that responsibility to the Brazilians, and by and large that is what we're going to do. But in this particular year, because of some adverse weather that Brazil had specifically going on in the south, the United States is competitive in the world market, and this is the one we need to watch. What happens with exports going forward here? This has been well documented. Brett Stewart was with us last night, and this will also have a little bit of an interface on what's going on with pork demand getting into Mexico. But right now, do you think Mexico is going to mitigate any shipments of corn from the United States anytime soon when they're experiencing a drought like no other? No, we're going to continue to ship corn to Mexico for as long as the eye can see here. China, which was a big player in this market, has suddenly become more of a bit player. I'm going to show you why in a little bit, but notice who it is. There's the United States. We're kind of that light blue box on the bottom side. Is China going to be our savior as far as corn exports are concerned? Absolutely not, right? And why is that? Here's why. Because China had an absolute record crop last year. They had a record crop. They'd rather deal with the Brazilians than the United States. China is not going to be our savior in the pork market. That's a little stealing Steve's thunder, but not really. But they're also not going to be showing up inside of what we've got going on with corn. This second crop of Brazilian corn has become more prominent here over the last 10 years. Almost all of that goes into the export market. First crop stays domestic and it's competing at harvest time with exporting of soybeans. The second crop is generally what gets exported, and that looks like it might be curtailed just a little bit, but notice the trend, and I think that's what's important, right? The world is going to look to Brazil in order to supply corn. If we take a look, I've shared this chart with you before. U.S. exports, in order to start here a year and a half or so ago, we thought were going to be pretty lofty. They fall. And notice what happened, right? That Brazilian corn came into play. The United States is not going to be a player. We are now the number 2 supplier to the world. After 40 years worth of dominance in the export market, we're going to become a bit player. Let's shift gears here. Corn balance sheet's relatively boring. Bean balance sheet is going to get interesting. We are heavy, guys. 25 million metric tons more across the world than a year ago. And notice that most of that is coming out of Brazil, Argentina. Argentina 2 years ago had a 25 million metric ton crop. They did a good job on the crop this year with good production. But we're just going to continue to add to the stocks of soybeans across the world as time goes on. A lot of that hits this bottom line. Our ending stocks go from 111 to 128. That's a big jump. Notice that our corn stocks went from 313 to 312. They stayed very, very static. Not so with soy. We are going to produce more soy than we can utilize and then we can export, and the price is going to have to come down. This is what our S&D looks like, 52 bushel to the acre. Would that be a record, by the way? 52 bushels the acre. Would that be a record? Yep, that's what we're looking at this year, a record crop for both corn and soy on the balance sheet in order to start before we'd even turn to wheel here. But notice what happens to our ending stocks. They also bloat from 340, which is comfortable, up to 445, and that's too many, guys. That's too many stocks across the world. That's too many stocks in the United States, and the price has to respond. And that's why if you are a farmer, if you're an agronomic farmer, and you've got beans in the ground and you haven't sold your new crop yet, this is a huge hint. We've got to get out in front and do that. They're trading at about $12 earlier in the week. Notice that the USDA is saying that the average price is going to be $11.20. Our regression models would say closer to $10.75 by the time you get there. This is your opportunity. What does that mean you should do a soybean meal? Fold your arms and just say no, right? Right? Was it Barbara Bush that said just say no? Who is, right, just say no to drugs. We're going to say just say no to soybean meal, right? That's going to be our new mantra as we roll forward here. Export inspections of soybeans have generally been above pace. That will start to back off here soon. And here's what we're looking at. These are our previous 4 years of shipments to China. Notice where we sit here. Our number one market for beans is fading back. Has to do with the Chinese economy that is not as robust as it has been, has more to do with Brazil taking over more of that market share from the United States. So all of this is starting to paint a picture where the United States, except for some unique circumstances, is going to remain more insular as we roll forward here. I like this graph, by the way. This is this year. This is what we're taking a look at. This is the year we're churning through right now. But notice what the prospects are. We had a record year of production last year / the last 6 months coming out of Brazil. We're going to have record production this year for the crop that's growing in the United States and the crop we're projecting for Brazil. We're not running out of soybeans anytime soon. Which brings us back to this insular nature and we're insular situation of trying to save the world through decarbonization. And the whole renewable diesel thing is slow. Right? We've got overcapacity of production of soybean oil in relationship to how quick these plants are coming online. Some of it's due to regulatory components of the plants themselves. Others have to do with what goes on in Washington, D.C. of rules and regulations. And this whole climate change as the world evolves is going to have an impact on your business. Right? Renewable diesel is still herky-jerky, SAF, no capacity coming. And the monetization of the Inflation Reduction Act is going to mean something to you. And that's what I'd like to kind of spend here a few minutes talking about. It has everything to do with what's called a 45Z. And I'm going to bore you here just a little bit, but this is important. The Department of Energy recently came out with ruling on 40Bs, which put the corn growers, the bean growers up in arms, put Chuck Grassley up in arms about how it was unfair and not very reliable. Has nothing to do with the key component. You can kind of ignore what's going on with that rhetoric. Everything is dealing with carbon. And the far right-hand column is the one I want you to pay attention to, because more than likely, you have been approached by someone that wants to partner with you in exchange for some monetary piece, whether it's on the far right side, 10-year contracts or carbon insetting. The beauty of this carbon intensity piece is there are no contracts. This is nascent. We're still developing everything, and I don't know where it's going, but I have a feeling that it's going to be much, much better to the pork producer than anything we've ever had in the past. And it's by accident, quite frankly. This 45Z money flow is a tax credit to the biofuel manufacturer. That's your ethanol plant that they are going to have to monetize that somehow. And this is where you sit in the middle of this. As an agronomic producer, it is still unknown how this is all going to play out, but I'll kind of walk through this. In order to get the money, you've got to get your CI score as an ethanol plant below 50, and the average right now is 53.3. So there's a little bit of work to do there. And if you are an ethanol plant, and in this particular example, it's at 55, notice where better than half of your carbon intensity score is right here. It's in the corn piece. And the normal carbon intensity score, and just stay with me on this, is 29.1. So that becomes our baseline of where we're going to go. But kind of the math is really, really big by the time we get there. is for every point reduction in CI score that ethanol plant can demonstrate, they're going to get what's the equivalent of 5.5 cents per bushel of credit back against their taxes that they can either use to offset their income or sell onto the open market with just a little bit of a haircut in order for somebody else to take it. But this is real money, guys. Now we're dealing with the Department of Energy, we're dealing with the IRS, and so who wants to lie about their numbers? By the way, when you're dealing with the IRS, right? Steve Meyer might be the only one that looks good in orange, right? The rest of you would look terrible. We got one other gentleman over here in orange. You look good too, right? Here's the math. We're based on a GREET model, which comes out of Champaign, Illinois. It is run by the Department of Energy, and it's got to have, the IRS has got to be complicit in how this all comes out. There's three big plays here: cover crop tillage practices and manure. And the numbers are all symbiotic. So if you're doing 2 out of the 3, you get a bigger number. So it's this whole model. So you can't just do the math yourself. The data that I'm going to show you comes from our friends at Continuum. They will be happy to do it for you. But I just took an example here. This is from Chickasaw County of a carbon intensity score. This is without manure on the ground. This is the same practices with manure on the ground. And that's just numbers right now, right? That's just numbers, 18.7 to 3.2. You say, what does that mean? Well, here's what it means. That 14-point reduction in CI score at 5.4 cents per bushel is 75 cents. And if I've got 250 bushel corn, that's $190 an acre, right? We're not talking about high oil corn or some of the other gimmicks that we had where you had to identity preserve it and you might get 5 or 10 cents a bushel. We're talking about real numbers here. Now, this is the value going to the ethanol plant, but if the ethanol plant is making 75 cents a bushel, are they willing to share some with other people in order to access that? The ethanol plant can't grow it themselves. They're going to have to get cooperation. And this is where the negotiation takes place of how much that our corn that we're growing can contribute to that, right? We don't know yet whether or not the corn that's grown on your ground, that logistically, if we're going to save the world through decarbonization and decrease our diesel fuel burn, if we're growing it on a section that's across the street from our feed mill, where should that corn go? To the feed mill or to the ethanol plant 20 miles away, right? Right now, we don't know whether or not the government is going to declare, nope, that's the corn you have. It's got to deliver to the feed mill, which you do have sufficient economic inspiration to do so. It just doesn't make any sense. Or do I get a voucher? So my credit score, my index scoring, then comes back to me and I can sell that voucher to another farmer. It becomes fungible. That makes a heck of a lot more sense. And I think that's where it's going. But we've got a 3-year program and we haven't started it yet. It starts in January of 2025 here. That's right. But it is big number. What does that look like? The value of manure just went way higher. You're talking nearly $200 an acre for what you're already doing, right? This is not changing any other practice, which makes the value of your manure go sky high. If you've got manure easements that are for free, should we be rethinking those, right? And if you've got a neighbor that's suddenly saying, you know, I'd sure like an extension, do you think maybe he might be cued into that a little bit on this? Right? All right. The value of our byproduct just went really, really high there. The value of the crop ground that has manure applied on it also, for the exact same reason, just went high. And so whether that's your ground that you're applying it to, or if the neighbor has an easement and you might want to buy a parcel of ground, when would be a good time to do that? Right about now. We've got the land talker in here in the room right now that shared with me earlier that we are starting to see some softness in the market. This type of program will usurp that. We can have a general softness in the market and a pocket that sees appreciating value, and I think that's exactly what we're going to see in here right now. If you are competing with the ethanol plant for your corn, your basis just went higher, right? They're making money. Can they give away just a little bit more money just to make sure that they keep that plant operating? Absolutely. And if we ever get into a short crop situation, this is going to get really, really interesting, because essentially what happens is ethanol becomes inelastic demand, right? Oh, they're stealing Dr. Meyer's thunder again. Demand is disappearance at a price, unless it's your heart medication, right? What happens if the price of your heart medication goes from $10 a month to $100 a month? Do you use less? Nope. coal, right? That's inelastic. That's inelastic demand. You're going to use it no matter what. And as soon as we give profits to the ethanol plant, they're going to take them here. All right. Let's wrap this one up here. Details of the 45Z. This is going to be an ongoing saga, but I just want to give a little bit of a primer there of when you see these news flashes come out, and maybe you've just ignored them so far. Don't do that anymore. Let's pay attention to what's going on and how that means and what it's going to mean to us here. The odds are still favorable as far as the input pricing for animal agriculture here, right? We've got about 6 weeks left in the growing season. I realize the growing season is going to go further than that, but we've got about 6 weeks, and corn is going to identify what its direction will be. And as long as this forecast remains consistent, I think the price is going to come under pressure. Once we get down to someplace 440, plus or minus, you might want to start to take a look at. I think you're going to see some value proposition. The soy situation, though, is just an absolute layup. We've got too much soy in the world. We've got too much soy in the United States. And the die is cast, guys. We are going to take this whole complex lower unless we get a complete disaster in the United States, which I don't see happening. We're going to take the entire price lower. And with that, I would take any questions while Dr. Meyer prepares to come up to the stage. All right, Dr. Meyer, here's the clicker. Here you go.
Good morning. It's good to be with you again. Let's kind of get into this. You've heard the optimist this morning. Now it's time for the dismal scientist. So, and I'm not exactly pessimist, but I'm not as optimistic as I was a couple months ago. Same disclaimer Joe showed you a while ago. I added one in here about nothing here should be construed to suggest output or pricing on the part of producers or packers. By me personally, by Ever.Ag, by the National Pork Board or National Pork Producers Council. My comments are based solely on my opinions of what market forces will cause to happen. 2023 was not a banner year for hog producers. Now, that's not news to anybody in this room. It was pretty bad. That minus 27.71 on our cost and returns model, which is based on the parameters that Lee Schultz uses up at Iowa State, was the worst number for a year in history, even worse than 1998. Now, the caveat on that is that that's a number that implies hand-to-mouth purchase of corn and soybean meal and selling of hogs at the national average net price on an ongoing basis. No risk management on either side of the operation is in that 27.71. And we know that producers were far more active in managing risk last year than they have been in the past, especially in 1998. The availability of LRP and LGM insurance, just an increased knowledge level of using futures and options. So I don't think that the actual losses would add up to 27.71, but they were still bad. And so the point is that we're coming off a tough year of massive losses, and that, Lee, should mean that we produce a lot less pork, right? Absolutely. So much for economic theory. So we're going to talk about that's not working exactly that way. And the other one is the 24 number at minus 224. Now, I use Lee's historical numbers, but I have a prediction equation that predicts costs based on corn and soybean meal prices, and then just use the lean hog futures to project what profits might be for this year. That number 2 months ago was right at $10. It's now minus 224. So there's kind of where my pessimism is. This thing has softened some in the last couple of months. And so operations that 2 months ago were looking at this year and saying, we're going to be in the black and we can make up some of what we lost last year, are now going, I'm not so sure about this. And so that's going to cause some problems. My mantra for the last year or so has been that one or more of three things had to change to bring us back to profitability. Cost had to decrease, demand had to increase, or we had to cut supplies. One, you can pick and choose what you want to do, but something had to happen on that. And a couple months ago, I gave them a score of 0 to 10 on those, and I said, well, costs have come down some. That's a 5. Demand had increased. We'd had pretty nice demand in the spring, winter and spring. That's a 7. You get a 0 on cutting pork supplies. All right. Well, if I had to redo those now, I'd give you a 4, 4, and a 0. I don't think costs have come down as much as what I thought they were going to. Domestic demand has certainly softened over the last several months, and we're still not cutting supplies. So that's kind of where we stand, I think, going forth. And I'm going to start today with pig supplies. One of the points about 2023 that we need to realize is that was not self-inflicted. I've been at this over 30 years, and just about every time we have a disaster in the hog business, we only have to go as far as the nearest mirror to figure out who did it. It's usually because pork producers got ahead of themselves and raised more product and put more product on the market, and the price crashed and it was trouble. That wasn't the case here. We've been cutting the breeding herd rapidly. We've had a steady pig crop for 4 years now. Just no growth in the number of pigs that are out there. If we look at hog slaughter, those translate into lower slaughter in 2020 and 21, and just modest growth since then, and I think only modest growth for this year. So we're not just burying ourselves in pork here that has caused this. If we look at the hogs and pigs supply, pigs report, you see a lot of numbers right around 100% there from a year ago. This report in March was pretty much as expected. It has a few kind of warning shots in it. One of them is the under 120 pound weight categories were both up 1.5%, which would say we're going to have more pigs in the second half of this year than we had in the first. But the others are kind of non-committal. The breeding herd wasn't down as far as analysts thought it would be. I thought it was about right. But the number to watch on here is the bottom one, pigs saved per litter. And we have been rolling on this number the last year or so. Now, this shouldn't really be a surprise to us because we were growing litter sizes by 1.3% before COVID came along. Since then, we've had a lot of complications. The major two being PRRS, the new strain of PRRS, and some labor difficulties in sow farms. And both of those have kind of conspired to keep litter sizes flat for 3 years. And then last year, both constraints kind of went away. It's not that PRRS has gone away, but it isn't as bad as it has been in sow units. And we certainly have increased our labor situation and got that back up to a more manageable level. And what's happened to litter sizes? They've gone right back to that long-term trend that they were on before COVID came along. And if you think about the genetic capabilities of the animals that we have in our herds, that makes sense. The progress in the nucleus herds has still been 1.5% per year on pigs saved per litter, even while we weren't capturing it on our farms. And the animals going back into our herds, the replacement gilts, were better than the ones we were taking out from a genetic standpoint. And so it was a matter of time until we went right back to the genetic capabilities of the herd that's out there, and that's exactly what we've done. Now, we have one more quarter here, right there, that we're going to compare to last year, that number right there when we get the June hogs and pigs report. That number is probably going to be plus 2.5%. It's not going to be plus 4, 3.8, and 4.6 like it has the last 3 quarters, but it's still going to be a pretty good number. From there on, the year-over-year comparisons, we're going to start comparing to these good numbers. So the year-over-year changes aren't going to change very much, but they're still going to go up. And so productivity is going to continue to contribute to output here, and that's really the reason we didn't cut back supplies. I mean, we cut the sow herd. We just raised a lot more pigs per litter, and so productivity has overwhelmed kind of what we would have done normally. This means, this is our forecast for quarterly slaughter this year. Here's Lee Schultz's forecast. Notice our annual numbers and LMIC, we're kind of pretty close, not too far apart. Our fourth quarter numbers are significantly bigger than some of the others. I always account for how many slaughter days are out there, and we have an extra slaughter day in both those quarters this year. And so that certainly helps us here in the fourth quarter of this year. But the point is that from 22 to 23, we grew by 2%. Even with all those losses in 23, we're growing by 1.7%. We think that that's going to probably continue going into 25. And it really causes us some problems out here in the fourth quarter. The black line is our forecast for weekly slaughter on 5.4 work days per week. And of course, we lost the plant, or we will lose the plant at Perry, Iowa at the end of June. And that reduces our slaughter capacity. We've had some increases at some other places. We have the extra slaughter day in both of those quarters that helps this number out here and kind of keeps it reasonably close to where we were, but we're going to be very tight. And if you look at this just for barrows and gilts plant, it gets much scarier because all the slack we have in this business is at sow plants. I mean, we could kill 85,000 sows a week, and we only kill somewhere in the 60, 65,000 sow range. And so the slack is there. It's not in our barrow and gilt plants. And so I'm a little concerned about, I think we're going to have a lot of pressure on spot hog prices, just like we did last year. I think you're going to see negotiated prices in the 50s for sure, and maybe down in the 40s at some point here this fall because of how tight we're going to be on slaughter capacity, unless we just really have a great demand thing. Here's the barrel and gilt picture. Like I say, that looks a little scarier yet. All right, the problem I have right now is what's going on with weights. Producer sold barrels and gilts is on the left here. And notice, normally they go down. Now, last year was a one-off. What was happening to your profits in April and May of last year? Whew, it was awful. Those were pricey pigs. They had never had a bite of cheap corn in their whole life. And man, I mean, they were really high cost, and you were losing lots of money, and we were cutting weights like mad because feed costs were high, and we were losing a bunch of money. This year, not so much. And in fact, we're not even going down at a normal clip. Now, this big spike here for Memorial Day is not a surprise. Every pig in the country got to live one more day, all right? And so that impacts weights. But notice, it's just not going down. Now, the question is why? And there's two possible answers. One of them is the pigs have really performed well. And I think for sure that happened because we've had really good weather. I mean, we haven't had any hot days that would restrict feed intake. The pigs have really done well. I think that's part of it. But the other possibility is we're killing almost exactly the right number of pigs based on the March Hogs and Pigs report. The difference between actual slaughter and my forecast so far since March 1 has been 1/10 of 1%. I don't ever get that close, all right? I mean, it's really and the USDA weight categories are off by 0.3 of 1%. So we're killing exactly the number of hogs we expected. But if we're having them get this heavy, could that mean that there's more pigs out there that we're not getting slaughtered every week? We're killing the right amount, but the pigs are getting heavier. Are we backing some up? We don't have an answer for that, and you don't get an answer for that in 2 or 3 or 4 weeks, but that's kind of scares me right now. Packer-owned pigs have kind of got back to a year ago. It's hard to explain here. One of the things you got to realize is that Smithfield accounts for over half of the Packer-owned pigs, so whatever's going on at Smithfield usually kind of determines this. Last year, they were having operational problems at their plants in North Carolina. This year, I don't think they have, and so they've got those pigs moved a little more efficiently. Here, you put them all together, still a little uncomfortable about what we're doing with weights here, and I don't think we have enough data to decide that yet. We do think that weights the rest of the year are going to be heavier than they were last year because of the feed costs, and so that's going to contribute a bit to pork production. But when we take pork slaughters up, weights are going to be up some, and yet per capita availability is down. How's that work? Well, it's called exports. We're going to increase exports by somewhere around 9% is what the latest forecast from Brett Stewart out at Global Agritrends is. And that takes product away from us. We have a little population growth. We're actually going to pull per capita availability down this year, which is positive for prices in most cases, but we're certainly not burying things. Now, this number stays roughly between 50 and 52 pounds forever. It's been there almost every year since 1980. These 5 years right here were a reaction to the ethanol program and significantly higher costs. We've adjusted to that. We're back in this 50 to 52 pound range. We're a little bit outside of it this year, but nothing to write home about. But the point is, exports are really important here when we talk about supplies. We're watching sow slaughter pretty closely. Last year, of course, we had a lot of weeks of significantly higher sow slaughter from May to October. That was almost solely accounted for by the liquidation of the Smithfield farms in Missouri. So that's really what drove sow slaughter. Now, when we get into 2024, we see these spikes back in the spring. Part of this was due to some weather, but there were a number of depops, repops that happened in January and February that pushed sow slaughter higher. Now, the important thing to know there is a depop, repop does not eventually reduce the sow herd because they come back. The repop deal. It does create a little bit of a less supply of pigs for a few months following that, but it's not a permanent deal. So we've been watching that pretty closely. The question is, what's going on here in the last 3, 4, 5, 6 weeks? We've seen a little bit of a run up again. And we know of a few depops, repops that have generally been slow. But the question that I have, that I'll be watching pretty closely over the next couple of months, is this an economic situation? Because what did I tell you a while ago? Back in March, we were looking at plus $10 for this year. Now we're looking at -2. And it's our opinion that there are a good number of operations that were financially kind of on the knife's edge here of being able to continue. And if you were sitting in March looking at $10 profits for this year, you and your banker were probably going, I think we can hold on. Joe's point, it's going to get good if you hold on long enough. I think we can hold on. If you and your banker are looking at -2 or $3 now on my model, or whatever the equivalent in your operation is, then you're going to say, maybe we better start liquidating. That could be happening, and we'll be watching that pretty closely here. Again, I don't think we have enough data to make that call at this point. Sow slaughter as a percentage of the breeding herd is over 1%, which would say we're reducing the breeding herd, even though my calculations say, I'm not so sure. Normal gilt retention would say we're building it slightly from quarter to quarter, but we're going to stay under a year ago levels at least until December. Okay, production costs. Now, Joe talked about, this crop's going to get better. We're probably going to have a break in soy costs. If you just use futures where they stand right now, we're not going to break it very much. Now, we're down from $97 last year to $86.59. That number's been bouncing between 82 and 87 pretty much all spring. It's kind of toward the top of that at the present time. I agree with Joe. Crop conditions, planting, all of those things look pretty good. The weather outlook is positive. But still, what's possible here? Well, if we were to take corn to $3 and corn to $3.75, let's put it that way, and soybean meal to $3, we would still be at $79 break-evens on this model. So lower doesn't mean low. So we need to keep that in mind. We might get some breaks on feed ingredients, but here Lee Schultz screwing this up again. Iowa State, Lee put in non-feed variable costs. The last 2 years went up. Fixed costs, he redid his fixed costs, which he always does about every 5 years, added $8 per head last year. Those aren't going away. And so that's the reason that in 2020, we had $63 break-evens, and if we had the same corn and soybean meal prices now, we'd be in the upper 70s on break-evens. So while feed costs may go down some, I don't think we're going to have low break-even costs at all. Most of you know I'm retiring at the end of July, but I think even if you go beyond my career, it's going to be a real rare occurrence that we have a break-even cost on this model start with a 7. All right, it's just probably not going to be happening very much. All right, let's look at demand. The third factor that I talked about was demand. Demand's been a wild ride. This is beef, pork, chicken, real per capita expenditures. You can see a huge jump in 2021 and 22. And if you look back, that correlates almost perfectly with stimulus payments from the government. Todd Gall, one of our colleagues in Chicago, was at our meeting last night and told us, when they add it all up, the federal government put $13 trillion into the money supply in those 2 years. And that means, that can be stimulative to demand, and it certainly has showed up. The interesting thing is meat demand went up when that money started appearing, and meat demand went right back down when the money's disappeared. All right, so I think that was really the driver. But notice we still are based historically, this demand is still quite strong for beef, pork, and chicken. If we look at just pork, you can see the two outliers, 21 and 22. Quantity and per capita availability or consumption here, real retail price here, outliers of those 2 years. Here's 23. This is where we would be for 24 right now if the average price for January through April prevails for all of this year. A little bit lower, but still within this pre-2021 family of observations, which I would say along that same demand curve where we were before that time period. Pork real per capita expenditures, again, bad last summer. We had a really soft first half of 2023, a good recovery into the fall, and then it's softened some as we've gone through 2022. If we look on a monthly basis through March, we were down about 6% on real per capita expenditures relative to last year, but that was pretty strong in the first quarter of last year. April, my estimate for April, it would be a positive. And here was the real soft period for demand last year. Was April, May, June, July, into August. Perhaps we can beat that as we go forward. Beef demand is still pretty strong, up 3%. Chicken demand pretty much unchanged for the year so far. One of the sources of help that we've thought would come is beef prices. And beef prices are certainly high, And beef prices could certainly go a lot higher if we ever start retaining some heifers to rebuild this cow herd. But if we look at the ratio of retail price of beef to pork, this is it, the blue line. And while that's a little high there, I don't think it's one of those things you say, oh, wow, that's going to be really stimulative of pork demand from substituting pork for beef, when it's not that much out of the norm relative to the last 5 years. Now, could it go out of the norm? Absolutely. If that heifer to retention starts, I think we could see this price ratio go up. But one point I will make is some research that the Pork Board did this spring with Glenn Tonzer and Jason Lusk and did some demand calculations is those cross-price elasticities of beef, pork, and chicken are not as large as they used to be. So I don't think we can hang our hat on that saving us at any time soon. A lot of talk about the general economy and a lot of misperceptions. You know, we're coming off of very rapid inflation for a time period that's come down. It's not nearly as low as the Fed would like to see it, but 3.8 is a lot better than 9 on inflation rates. We have an unemployment rate that's hovering just below 4%. There was a survey done recently, and over half of Americans believe we're in a recession right now. We are not even close to being in a recession. This is real GDP growth. The blue line is year-over-year percentage change, almost 4%. I mean, it's really been pretty good. If you take the quarterly rate annualized, that one has softened a little bit, but still, we're on the positive side of this. This is not a recessionary economy right now, and all of the indicators, most of the indicators are still pretty good. There are a few that aren't. Credit card debt has jumped. Delinquency rates on credit card payments has jumped dramatically. So there's some kind of cracks showing on the consumer side, but it's probably not going to impact us in 24. Bob Dealey runs an outfit called No Spin Forecast in Chicago, and Bob is a wonderful macroeconomist, and he has a model that predicts business cycles, and it is saying a recession is coming, and it has said a recession is coming for about a year. But Bob would tell you it ain't going to happen this year. It's still out into 25 before that's going to come. And so I still think we're in pretty good shape on the demand side, at least from the macro impact of consumer expenditures and those kinds of things on demand. The world situation has changed dramatically in the last several years. Of course, China has rebounded from their African swine fever loss. They were the real driver of this big reduction in world supplies in 2019 and 20. 24 is going to be down about 1%. We rebounded by about 20% over the last 4 years on total world supplies. If we look at individual suppliers, you can see China on the left here. Let's go back here. China on the left is the green line, which dominates everybody. This is Europe, the purple line in the middle there. And that little decline from what appears to be a little decline from 21 to 24 is really pretty significant. Remember that China on this chart makes this scale awfully large. So what appears to be a small decline in Europe is actually pretty significant. That decline is 1/4 the size of our total production. That's how much European production has gone down. And so it's a big deal. If we throw those three out, China, the EU, the United States, here's the other markets and others, that's others right there. And notice the green line going up. Brazil is the one to watch in the long term. I don't think they're going to take over things by any stretch in the next year or two. They still have some problems with foot and mouth disease, but they have applied for nationwide status of foot and mouth disease free without vaccination. They have 2 states that are already approved that way, Santa Catarina and Paraná, and they have applied for national status of that. So if that's the case, then they overcome one of their big trade barriers, and they are certainly growing their output very steadily. And with what Joe told you about corn and soybean meal, you think they've got the capability to raise a few more hogs? I think they absolutely do. And they're already the #1 exporter of chicken. They're already the #1 exporter of beef in the world. They're coming for us. They're way behind. Remember, look at the left one over here. They're very small relative to us, about 1/3, but still they're growing. The other one growing here is Russia, the blue line. That's mainly self-sufficiency, even though they're going to probably start exporting more to China. This Vietnam line right here comes from FAS, and all the veterinarians I talk to say there ain't no way Vietnam has responded that kind of way after having ASF. And I'll refer you to the blue line on here, the dark blue one. That's the Philippines. So I don't know how Vietnam could get that much better and Philippines could make no progress at all. Now, the industry in Vietnam is much more modern than the Philippines, no question, but still, I think FAS is a little rosy on that one. Okay, so here's what this adds up to for exports. The EU has been the dominant force on world pork exports for several years, but they have basically walked away from that. Their reduction in output, which has been driven largely by their own environmental policies and animal welfare policies and those kinds of things, has said that they're basically out, they've given up all the share that they gained, especially in China during ASF over the last 2 or 3 years. In fact, the United States will very likely be the largest exporter in the world again this year. That's the first time since 2014 that we've claimed that status. I think we're going to stay there. I think we'll probably stay ahead of the EU for the foreseeable future. Notice we had the big surge. We captured some of the China business there in 19 and 20, but if you go back, this is a pretty good, pretty steady long-term trend upward that I believe we're going to stay on. The other two factors in the market are Brazil, the orange line here. They passed Canada, which is the gray line, and there are 4 players in exports: the EU, the United States, Canada, and Brazil. And I don't see anybody else really challenging that for any of the real sizable market share on pork exports. If we look at U.S. exports, we've had a really good year so far. We're up about 8% for the year. Only 2% in March, but still very good for the year. As I pointed out a while ago, Brett Stewart and the folks at Global Agri-Trends have pegged that at 9. If we look at the individual countries, Mexico dominates. They take over 40% of our exports, about 10% of our production goes to Mexico now. The second largest market is still Japan, but, it has been Japan. Notice, though, the ascension of Korea into the number 2 spot on this list, and that is mainly because we picked up market share from the Europeans. In Korea, I think that's probably there to stay as well. Other markets is very important. The ones not listed here are very important to us as well. A lot of those are Caribbean markets, and you can see some of these right here. I guess Japan is barely number 2 for year to date. Here's the monthly figures where Korea has really made some progress. 54% for Korea, 8% total. Again, the top 4 here account for about 70% of our total exports, and I don't think that's going to change. So what are my expectations? Well, number 1, Joe stole my thunder a little bit. Don't look to China for help here. It just ain't going to happen. They will come to us in an emergency. If you look historically, we'll go back to that, maybe. Pointed at that and it'll work. If you look at the red line for China, it's not a real pretty picture. They bought from us in 2008, preparing for the Olympics. They bought from us in 2011 when they had Blue Ear. They bought us from in 2019 and 20 when they had African swine fever. There's a pattern here. They come to us in emergencies, and I think that's the only way they're going to do it now. Their demand situation seems to be quite soft. Their economy is soft. We hear of some real problems in their real estate businesses, and so I think that we just can't count on them. And we still have the 25% punitive tariff over our tariffs on aluminum and steel. It's still in place. President Trump put that in place. President Biden left it in place. I think President Trump-Biden is probably going to leave it in place coming. So I don't think that's going anywhere anytime soon. Mexico set a new record, as we pointed out, really growing. And really one of the main drivers here is, I've told people, a bit of a shock. I used this word strong peso in the same sentence. I didn't think that had ever happened, but the peso has strengthened dramatically over the last 2 years. And a lot of it is economic development in Mexico. This nearshoring of supplies of various industrial goods to the United States has brought them to Mexico. Mexico is the largest exporter of products into the United States last year. Mexico, not China, okay? And that's probably going to continue. And if that continues, then the Mexican peso will probably stay strong. That's great for us exporting to them. That makes our product much more affordable to their consumers, and so going on. Now, the opposite is the pink line here, and that's Japan. The yen has lost tremendous value. Now, It's not just us. They've lost value. It has lost value relative to all other currencies. So I don't know that our relative competitive position has really been hurt in Japan, but it's certainly taken away the buying power of Japanese consumers, and that's going to be a problem. The other currencies are relatively stable. All right. We go on, big EU output productions. We talked about that, especially opportunities in Korea and Japan. The challenge is the yen, up about 9% for the year. So if we put domestic plus export demand together, the place they come together in the U.S. market is the wholesale market. And this was June of last year. Notice the outliers for 14, 21, 22, very strong wholesale demand. 23 was back in that family of pre-2021 demand levels. Here's where we were last week. 23 improved steadily the second half of last year. Ended up kind of in between. Right now, I would put wholesale demand for 24 almost back up to the 21, 22 levels. But it's not thanks to what's going on here in the United States. It's thanks to what's going on the export market. And so a little better situation at the wholesale level. When we put those together, my forecast for prices, and I've got two. One of them is the national negotiated net price, the left-hand shaded column. The other one, I put that together with a forecast for the cutout value to forecast what we think the CME lean hog index would do. And then, of course, we have that relative to what the actual futures are. This was last Friday. I understand we took kind of a hit yesterday, and so those numbers would be lower. These numbers would be more negative. So we think that the summer markets are pretty soft right now relative to where I think they're going to be. The fourth quarter and first quarter of next year, we're offering some pricing opportunities, I think, at least last Friday. But you can see 81.32 on the index last year, somewhere in the 85, 88 range this year, 83.50, 83 to 85. Here's Iowa State, here's LMIC. We're all kind of in the same ballpark. We're not very far apart. Some softness going into the first quarter of next year. Here's a chart of that. We'd have the cutout value peaking somewhere in the 107, 108 range here this summer. Notice the big advantage in the first half relative to last year. This was that very soft demand in the first half of last year. What happened in July last year? It's hard to give credit to Prop 12, but we have to. I mean, when Prop 12 made the announcements you could bring in non-compliant product to the end of the year, everybody started stocking up because they also kind of said, man, we're not going to enforce the law until January. And so a lot of product went in there, and we really got a shot in the arm going forward for the second half of the year. So we'll be a little lower there for a while, but the fourth quarter is still going to be a challenge. Lean hog index, again, here's where futures were last Friday. We thought they were a little low through the summer, but pretty reasonable for the fall. Okay, conclusions. Costs are falling. The amount will be limited, in my opinion. Mid-80s, maybe the low 80s. With the challenges we've had with planting, not so sure on that. I will point out, and Joe didn't mention this, if you want to predict what the crop is going to be, one of the things that you don't want to try to use is planting progress. It's practically unrelated to what the size of the crop is. Anything that happens with the speed of planting in the United States can be swamped really easily by the lack of rain or the presence of rain the third week of July and the temperature during August. I mean, it just disappears. So it's not a major factor. It's something we watch, but if you're going to try to predict the market, it don't work. Consumer level demand will remain below the 21-22 levels, but probably in that pre-2021 level, which really wasn't bad. I mean, it was not bad demand. It just not as good as those 2 years. Exports, excellent. We're going to follow last year's growth with more growth this year. We will export 27.5% of our production this year, of our carcass weight production. That's a big number. And for several years, a few years ago, there was a lot of discussion of, boy, we're getting too dependent on exports. Well, somebody came to the realization that if you're going to grow, you got to get dependent on exports because we're not going to grow this market domestically very much. We're not probably just keep up with population growth. That's not very much growth. So 27.5%, is that risky? Absolutely. Do you have any choice? No, you don't. It's still a good thing. And so what that means is we've really got to be vigilant about foreign animal diseases keeping them out, managing them well, managing them as effectively we can, should they ever come. The concept of regionalization and compartmentalization, we have to follow that with our partners because we're going to want them to follow that with us. And so it really puts a lot of positive pressure on that. The breeding herd will not likely shrink further. I think it's going to go up a little. That's the caveat of this financial situation right now. Do we have enough operations out there that are kind of teetering that now have a negative outlook for the future that might be pushed into liquidation? That would change this, but at the time I wrote this, I didn't think it was true, and I'm not sure I still think it's true now. So I expect slight quarter-to-quarter growth, but under a year ago. Productivity gains will keep 24 pig and pork supplies slightly above last year. Wholesale pork prices better than last year because, especially the first half here, demand has been much better, and pork supplies will not decline in 25. I mean, this is kind of a stubborn industry. We're not going to reduce the amount of hogs we produce out there. And it's one of the challenges of a modern high capital investment business is we have this asset fixity. I mean, if you're not going to raise pigs in a hog barn, just exactly what are you going to do with it? That's a problem. And so it's hard to get them out of production. It's going to be a challenge. I don't know, Joe, are you still here? Oh, yeah. If you got questions, Joe can come back up here and he'll answer the hard questions and I'll answer the easy ones.
All right, let's get into the question and answer portion of the conversation now. We've still got some time here. Any questions? Raise your hand high so we can see you because it's kind of like an auction. Okay, Colby Ferguson from Texas.
Thanks. My question, I went to the U.S. SHIP conference back last year, and one of the breakout sessions that was talking about litter sizes and things like that and how the United States still lags behind the rest of the world in litter size and pigs weaned. And they saw that as a place that could be of improvement for our sow operations. Listening to what you just said, is that accurate, or is that actually one of the drivers in our economy? Is it something that will wash, or, I mean, what's your thoughts on that?
No, it's absolutely accurate. The Europeans are still well ahead of us, in litter size. And I don't know what the advantage on that. It's probably still well over a pig and a half. It's more than that. For years, I always said the reason that the Europeans were so much better than us was that they had to be better than us because their feed was expensive. Correct. Okay, and it's still the truth. Their feed is much more expensive than ours, so they've got to be better. And so we're kind of on riding the European coattails on that. We've brought European genetics over here. We put systems in place that have allowed us to gain on this. But the genetics of these animals is going to keep going up. So I just was at another meeting before I came here, and one of the points I made, we slaughter about 125 million barrels and gilts in the United States. The last few years have been within spitting distance of that every year. All right? Think about the most efficient farms we have, Joe. We need 4 million sows of those farms because they're raising well over 30 pigs per sow per year. All right? And we have 6 million sows. So this sow herd is going to get smaller as efficiency grows. And efficiency will grow because it is such a driver of the economic performance of the individual farm. If you're out here with a sow unit, when you're managing that sow unit, you don't go and look and say, oh, well, I don't know if I want to put those extra pigs on the market. You say, no, I want to raise as many as I can out of that sow. And so the micro incentives will swamp the macro impacts on this one every day, and we still have plenty of room to gain.
Yeah, I'd agree with that, and then we'll get to the question here in the center. If I can build on this just for a moment, Dr. Meyer, I'd like to recognize Dr. Gordon Spronk that's in the back of the room as one of your board members that represents you on a daily basis of producers. Him and his producer leaders just came back from a trip in Europe in which they got to evaluate some of those production systems. I didn't have the opportunity to go, but as those producer leaders came back, they said, Brett, one of the places where the Europeans have a huge advantage is their ability to have more pigs and keep those pigs alive to full value market hogs. And so that is a competitive advantage, Dr. Meyer, to your point, that we're going to have to start to work through moving forward. Thank you.
Jennifer Carrico, DTN. to piggyback off this, and I realize I'm talking to a couple economists, and so maybe there's somebody else in the room that can help with this. But
Oh, did you say? Did you say?
We're not
veterinarians,
limited.
too.
We can be veterinarians.
okay, well, all right,
Yeah.
you can be
I thought
whatever
you
you
were gonna
want.
say something that could really answer the question.
My question kind of piggybacks off of that. At what point are we producing too many, and then we see a decline in the efficiency of the hog? I mean, if Europe is one pig ahead of us, what point? 15 pigs per litter, 20? I mean, it seems like there's only so many places for them to eat, and so what's that number?
There is some theoretical limit out there somewhere, and we will approach it asymptotically. I don't know where that is. I'll give you an example. One of the major genetic suppliers has increased the percentage of the animals in their nucleus herds that have 18 nipples dramatically over the last 4 years. They've put selection pressure on the number of nipples that sows have. And I mean, when I was a kid, 12 was good and 14 was really good. Mm-hmm. And the rare one that you had 16, and now they've got a decent percentage that have 18. So these things can be managed over time. We have good supplemental milk systems that can bring these pigs along and help the sows out getting them raised. I think one of the keys on that, though, and Gordon, you correct me if I'm wrong, you always do, is you got to have some labor and some knowledgeable labor in those buildings to get that done.
Yes.
It doesn't happen just with genetics. It doesn't happen just with building design and longer crates or bigger pig areas or whatever. You've got to have the management component is really important. And so I think that's one of the things that, our large farms are really good for some things, but it makes management of people in those things a challenge. Those farms in Europe that you saw, Gordon, were probably 600, 700, 800 sows at the most, right? And that's a much smaller management scope to look at than a 5,400 sow unit out there. And so I think that the labor and expertise part of that is probably as important. And if you have that, what I'm arguing is there aren't very many limits, or at least we're not very close to them yet, right, in my opinion.
Right.
Joe?
And it's the reason we're not doing 24-hour farrowing attendance. There's an economic threshold where you say, I'm not going to make any money anyway, and we're going to go through that. The genetic potential is there. We just got to have the economic stimulation to max that out, and economics will take care of it all.
Yeah. And our feed costs are high, and so I would say that high feed costs have probably created more of an incentive for that, because we're kind of where the Europeans were 10 or 15 years ago, but we still have an advantage on them in that case. And so that's one of the reasons we're doing pretty well in the export market. And don't get me wrong, the Europeans will be doing very well in the export market had they not decided not to do. Yeah. Okay, and they basically have decided not to do it.
Hi, Tim Ing with CK International about the EU deforestation regulation, and I know a lot of the premise of what we talked about today was about the growth in Brazil, but obviously the EU deforestation legislation is all really kind of targeting the Amazon rainforest. Yep. And what do you expect to see? Obviously, that legislation is not finalized. They're still working through it with all the different member countries and trying to figure out what's the right way. But what do you see with that one?
So let me take first swing at the piñata.
You're going to get the only swing at that.
Okay. When you're in Brazil, and I've been to Brazil a half a dozen times, and the first time you're down there and you're talking about the deforestation of the rainforest, and you have a picture in your mind of what it is, you're way late to the game. Brazil is very structured as you move away from that Amazon basis of how many trees need to be left on each hectare of ground in order to before you can have intensive agriculture that starts to roll. We are 20 years away from what I would consider to be that if we were to look back and say we violated the Amazon basis. I do believe that that was true at that point in time. The go-forward piece is being regulated more by the Brazilians rather than an imposition from the Europeans about how they're going to behave. So I believe that we're on the backside of that, and any further environmental damage that's attributed to such is negligible as we move away from the Amazon River Basin. I like what we're doing. We're basically turning what I call Manhattan, Kansas, really boring ground into something productive. It takes a little bit of lime. They've got they've got nutrients, they've got sunlight, they've got plenty of moisture. It just needs a little bit of fertility management in order to raise the pH of that ground, and it becomes very fertile. But it is not clearing a rainforest. It's more like taking a pasture out.
Wonderful. Thank you.
Thank you, Tim.
Did Kevin have a question?
Kevin Rasmussen here. Dr. Brett Kaysen, I just wanted to give you the opportunity, when we talk about pig livability and saving more pigs per sow per year and getting more good pigs to market, I think you need to go to the piglivability.org website and see all the opportunities, all the low-hanging fruit that we have there. And I think the National Pork Checkoff and the National Pork Board has done a really good job of laying out ways to save more pigs.
Good.
Yeah, thank you for that, Kevin. And I think it's important for you as producers to understand that Kevin is a newly appointed board member as well, representing the state of Iowa, and now you farmers in the room nationally. But porklivability.com, piglivability.com, excuse me. Lot of work. Thank you.
.org.
.org. Sorry, we have so many URLs. I can't keep them all straight. But thank you for the .org. The work's been done there, is Kevin's point. The research has been done. The path has been presented. The challenge then becomes, what are we going to do about it? And that's my challenge to all of us in this room. And if I could be very, very clear with you, there are some folks that believe we should research this topic more. The data is the data, the research has been done. The execution on the science is the opportunity. And there's lots of challenges about that, but that's our opportunity moving forward. And those of us in this room have an impact on executing that at a farm level. And to be quite frank, an obligation to do that.
Yeah.
Thank you for that, Kevin. Question in the back.
Hi, gentlemen. Sam Wildman with the Meat Institute. Apologies, I missed most of your presentation. So if you've covered this, just tell me and I'll shush. Beyond EUDR, where do you see other sustainability-related attributes coming into play at a market level for U.S. pork?
Boy, I'm going to leave that to Dr. Kaysen. He knows more about that than I do, for sure.
Well, Joe, take a swing, and then I can come in behind you.
I would tell you that the economic response that we're having domestically, I'm talking specifically domestically, is starting to put systems in place to track sustainability metrics. I did talk about carbon intensity in the scoring systems with the 45Zs that are going to be coming back through. So I would not give you an end-to-end coordinated component, but rather a series of one-offs that once you get enough dots, it starts to create a line. And we're someplace in the transition between dots and lines as we sit right now. I think a lot of it will come from the economic reward associated with it, and then putting together the supply chain that's necessary to meet that with the documented steps along the way. And we're someplace in the middle of that transition right now. I cannot give you a better answer to that. Dr. Kaysen?
Dr. Spronk has a comment relative to the question, I believe.
I think it's a great question. Recognize that Pork Board is active in this space from the educational mandate. I'd encourage you to seek out Jamie Burr, seek out Marguerite Tan. I don't know who else from his staff is here, Brett, you might know, but there's, 8, 9, 10 activities in this space. I'll name one. The current rules we play by are European rules, which means there's a life cycle assessment. You might want to learn that little term, LCAs. Well, the current LCA methodology is all European. Pork Board is active in saying, hey, you know, maybe there should be a U.S. LCA. We're active in that space, updating it as we speak, And then, of course, we would aspire to compare our LCA to the rest of the world, including Europe, so that we clearly understand and can educate our producers of where we should go in this space and have a healthy conversation about life cycle analysis, which really is the methodology that the world is using for sustainability.
Yeah, thank you for that, Dr. Spronk. An excellent question, Sam. I would expect you to ask one like that, given your history in our industry. I would bolt on to Dr. Spronk's comments and say you would have hopefully seen over time this drive that the National Pork Board's had specifically over the last 3 years about something called an on-farm sustainability report. Those things are funded with your checkoff dollars. Now, they're not free. You've already invested. And what Dr. Spronk is helping us with here is models and real data are different. Dr. Spronk?
Exactly. We can't leave this, Brett, without making one more comment. Most, if not all, LCAs are based on models. The models are based on data from 1990, 2000. Well, the environment and the world and how we, our agriculture of the 1990s is nowhere near, or we're nowhere near that today. So the language is the primary data, Brett. Our opportunity in U.S. agriculture to actually show that we're the best in the world is just produce the primary data and share it with the methodology that you're referring to. So a great encouragement for any producer in here, understand that primary data is very, very valuable because it's better than the modeling data.
Thank you for that. And those opportunities exist if you're not in those reports today. Come to the tent. There's a bunch of folks that'll talk to you about that. It's something I'm very passionate about, and it's years ago, Joe, we said, who's going to write the rules? And that was the vision of our producer leaders that are invested you in this room to say, well, let's chart our own course before someone tells us the course we should be on. But that only happens with your participation and activation. So on that, have a wonderful week. Thank you, Joe. Thank you, Dr. Meyer.
Thank you.